Elon Musk, the relentless visionary behind Tesla and SpaceX, has always been at the center of business headlines. On December 19, 2025, Musk secured a monumental legal victory. The Delaware Supreme Court restored his controversial 2018 Tesla pay package. This wasn't just any compensation. It started at $56 billion and soared to $139 billion, the largest in corporate history. The saga began with a small shareholders lawsuit, questioning whether such a payout was fair or simply excessive. The legal battle pitted Musk against a system designed to check executive power, raising questions about corporate governance nationwide. The journey was a roller coaster. A lower court rescinded the package, Musk fought back, and the case reached Delaware's highest court. The story is one of ambition, risk, and reward, with implications for boardrooms everywhere. We'll break down the origins of the lawsuit, the structure of the 2018 pay plan, and the Supreme Court's reasoning. We'll also explore Tesla's move from Delaware to Texas and the creation of an even more audacious pay plan for Musk's future. This is the story of how one CEO's payday redefined the rules for corporate America. Was it a fair reward for unprecedented growth, or a sign of a board too close to its leader? The outcome sent shockwaves through the business world. Let's dive into the details of this landmark case and what it means for executives, boards, and investors. The stakes and the rewards have never been higher. The drama began with Richard Tornetta, a Tesla investor with just 9 shares, filing a lawsuit after the 2018 pay plan was approved. Tornetta argued the package was an excessive transfer of wealth to Musk, enabled by a board too close to its CEO. He claimed the board's process was compromised, lacking true independence and transparency. The case, filed in Delaware's respected Court of Chancery, moved slowly but steadily. Musk defended the plan as a way to keep him focused on Tesla's ambitious goals. If he failed, he'd get nothing. Tesla's lawyers insisted the plan was properly negotiated and approved by disinterested shareholders. The lawsuit raised fundamental questions. Can a board be truly independent with a powerful founder at the helm? How much should shareholders know before approving such deals? Tornetta's challenge, though small in scale, threatened to upend one of the largest compensation deals ever. The stage was set for a battle over the very foundation of CEO pay. In January 2024, Judge Kathleen McCormick delivered a bombshell: Musk's entire $56 billion pay package was voided. She found the board's process deeply flawed. Musk controlled negotiations, and directors weren't truly independent. The court ruled the deal failed the entire fairness standard, citing hidden facts and incomplete disclosures to shareholders. The shareholder vote was invalidated. The package was erased. Musk's reaction was swift and furious. He blasted Delaware's courts on social media and urged companies to leave the state. The ruling not only stripped Musk of his payday, but also set him on a collision course with Delaware's legal establishment. The chaos that followed made headlines, and the case was primed for appeal. The decision was a powerful rebuke of Tesla's board and a warning to other companies about the importance of independent oversight. For Musk, it was a direct threat to his control and compensation. The legal fight was far from over. The next move would reshape the future of Tesla and corporate law. The stakes had never been higher for both sides. The battle was just beginning. Musk's 2018 pay plan was unlike any other. No salary, no cash, just a massive all-or-nothing stock option grant. The plan had 12 tranches, each unlocked only if Tesla hit ambitious market cap and operational milestones. Targets started at $100 billion in market value, rising to $650 billion when Tesla was worth just $59 billion. Each milestone earned Musk options to buy about 1% of Tesla at a deep discount. If all 12 were met, he'd get options for 304 million shares. Against the odds, Tesla's performance exploded. Production soared, profits grew, and the stock price skyrocketed. By 2025, Musk had unlocked every tranche, turning the package into a $139 billion windfall. Supporters said the plan worked. Shareholders gained over $600 billion in value. Critics called the payout obscene, arguing no executive deserved such a sum. The controversy centered on whether the milestones were truly tough and if the board exercised real oversight. The plan's sheer scale made it the most debated compensation deal in history. It set a new bar for CEO incentives and for public scrutiny. The debate over fairness and excess was just beginning. Musk and Tesla appealed, and on December 19, 2025, the Delaware Supreme Court overturned the lower court's decision. The $139 billion pay package was fully restored, a complete vindication for Musk. He celebrated online, declaring victory. The ruling meant Musk regained options for 304 million shares, boosting his stake in Tesla from 12.4% to 18.1%. The financial impact was massive, cementing the package as the largest ever for a corporate executive. Tesla's stock ticked up, and the cloud of uncertainty lifted. The legal saga was over, but its effects would ripple through boardrooms for years. The Supreme Court's decision ended a contentious chapter for Tesla and its CEO. The focus could finally return to innovation and growth, but the precedent set would shape executive pay debates for a generation. The Musk case had changed the rules. The Supreme Court's reversal wasn't just about legal technicalities, it was about equity. The justices agreed the board's process was flawed, but found total rescission too harsh. They argued Musk shouldn't go unpaid for 6 years of record-breaking growth that enriched shareholders. Voiding the plan, they said, would unfairly benefit the company at Musk's expense. The court gave weight to the shareholder vote, seeing it as evidence of investor intent, even if disclosures were imperfect. Their ruling balanced holding the board accountable with respecting shareholder wishes. The justices concluded the process was imperfect, but the results were extraordinary. Shareholders got massive returns. Musk got his reward. The decision marked a shift. Outcomes mattered more than process. It set a new standard for fairness in executive compensation disputes. Musk didn't just complain about Delaware, he acted. He led Tesla's reincorporation in Texas, with shareholders overwhelmingly approving the move. Texas offered a legal environment Musk saw as more favorable, distancing Tesla from Delaware's courts. The move had teeth. Tesla's new bylaws require any suing shareholder to own at least 3% of the company, about $30 billion worth. This effectively blocks small investors from bringing lawsuits like Tornetta's. Critics say it undermines shareholder rights. Supporters argue it shields Tesla from costly distractions. The move was a bold rejection of corporate tradition. For Tesla, it meant more control and fewer legal headaches. For corporate America, it signaled a potential shift away from Delaware's dominance. The message, powerful CEOs can now rewrite the rules. Even as the legal fight raged, Tesla was planning Musk's next incentive. In November 2025, shareholders voted on a new pay plan, bigger and bolder than before. The targets? Full self-driving, humanoid robots, and a multi-trillion-dollar market cap. The structure, all-or-nothing stock options, no salary, no cash. If Musk hits every goal, the package could be worth up to $878 billion. Shareholders backed the plan, betting on Musk's vision for another decade. The new deal dwarfs even the historic 2018 package. It's a massive risk and a potential astronomical reward. The debate over CEO pay and incentives is far from over. Musk's pay saga is more than a story of wealth. It's a turning point for corporate America. The Supreme Court's ruling signals that results can outweigh process, especially when shareholders profit. Boards may now feel emboldened to approve even bigger, riskier pay packages for visionary leaders. Tesla's move to Texas could spark a shift in corporate law, making it harder for small investors to challenge management. The case highlights the tension between rewarding success and ensuring fairness. For investors, it's both a cautionary tale and a lesson in the power of bold leadership. The $139 billion payday will be studied for years, a defining moment in the debate over value, leadership, and power. The rules of the game have changed, and the world is watching.